December 2001. America's seventh largest company files for bankruptcy. $63 billion gone. Thousands of employees wiped out. Wall Street stunned. Not because it happened, but because no one could clearly explain how. This is the story of Enron, the company that sold nothing, made billions, and then imploded while everyone applauded.
We have the people and the skill base and the experience to win in a competitive marketplace.
What are you seeing for next week and the balance of the month, eh?
Virtually every industry that's opened up for competition sees tremendous innovation almost immediately.
Picture a company that made its fortune moving natural gas through pipelines. Not glamorous, not dangerous, just pipes. That was Enron in 1985, born from a merger no one outside a tax attorney's office cared about. Then came Ken Lay, a PhD in economics, a deep tan, and one big idea: deregulation. If the government stopped telling energy companies what to charge, Enron could transform from a sleepy utility to a high-stakes energy trader. Lay brought in Jeff Skilling, a fast-talking McKinsey consultant with total faith in markets, spreadsheets, and himself. Skilling pitched a radical vision. Enron isn't a pipeline company. We're a tech company. We sell the future of energy. Wall Street was hooked. The turning point came with Enron Online, a digital marketplace for trading energy contracts. With a click, you could move millions. Enron started looking less like Houston and more like Silicon Valley with a cowboy hat. Inside Enron HQ, Skilling told employees they were the smartest guys in the room. Translation: perform or you're gone. Bonuses were huge. Backstabbing was casual. Every quarter was a performance to wow investors. From the outside, Enron looked like the future. Ask what they actually did, and you'd get a 40-minute buzzword presentation. But the stock kept rising, so no one asked twice.
We began by attracting the kind of people that are more comfortable in an environment of change.
You know when you work for Enron, you're going to see the newest thinking, you're going to see the newest products, the newest services, you're going to see the newest markets opening up, the newest ways of thinking about things.
By the late 90s, Enron stock skyrocketed from $7 in 1997 to over $90 in 2000, a 1,000% gain. But the promises were impossible: endless growth, no bad quarters. Energy markets aren't TikTok. They don't go viral every week. So Enron changed the rules with mark-to-market accounting, booking 10 years of projected profit the day a deal was signed. Even if the project hadn't started, even if it wouldn't make money. A key figure in the Enron scam was Andrew Fastow. Before his infamous tenure at Enron, Fastow was an up-and-coming financier with a strong academic background. After earning an MBA from Northwestern University, he began his career at Continental Illinois Bank, where he worked in the newly emerging field of asset-backed securities. He also met Jeffrey Skilling. In 1990, Skilling, who had since moved to Enron, recruited Fastow to join him. At just 29 years old, Andrew Fastow was now part of one of America's most talked about companies. Andrew was recruited as CFO. His specialty? Moving liabilities off the books into special purpose entities, SPs, shell companies Enron secretly controlled. On paper, Enron sells bad assets to an outside party. In reality, Enron was funding both sides of the deal. It was like selling your broken car to your dog, using your own credit card. Fastow's SPs hid billions in losses. Wall Street analysts continued to rate Enron a buy. Many worked for banks that made millions from Enron deals. The truth was buried under jargon. The motto might as well have been, if you can't explain it, you're probably doing it right. In August 2001, Skilling resigned suddenly. No scandal announced, just gone. The same month, the SEC starts sniffing around. VP Sharon Watkins warns Ken Lay in a memo. I am incredibly nervous we will implode in a wave of accounting scandals. Lay treats it as a PR problem, not fraud. October 2001, Enron admits to accounting errors, which is corporate code for "we cooked the books." $586 million in fake earnings vanish overnight. The stock free falls from $90 to under $1 by November. December 2nd, 2001, Enron files for bankruptcy. At the time, it was the largest corporate collapse in U.S. history. Thousands of employees lose retirement savings. Executives? They walk away with millions. Enron's auditor, Arthur Andersen, was supposed to be the watchdog. Instead, they were coaching Enron on how to hide fraud while cashing huge consulting fees. When investigations began, Andersen shredded thousands of documents. They were convicted of obstruction of justice and collapsed, taking 85,000 jobs with them. JP Morgan, Citigroup, Merrill Lynch all helped structure Enron's shady deals. They paid fines but avoided criminal charges. Skilling was sentenced to 24 years. Vasto got 6. Ken Lay died before serving time. Congress passed Sarbanes-Oxley, forcing CEOs to sign off on financials, a law born from Enron's ashes. Enron wasn't just a company, it was a warning. A reminder that the brightest lights can cast the darkest shadows, and that belief without doubt is the quickest path to ruin. For 16 years, Enron sold the future. When the lights came on, the building was hollow. The smartest guys in the room had vanished. But Enron is only one story. There are countless others, corporations that rose like giants and fell like frauds. The question is, which would you want to know next? Let us know in the comments section. Don't forget to like, share, and subscribe so as to stay informed.